Okay, folks, welcome back, and to the new students, welcome to the Inner Circle. All right, so this is going to be a rather, I don't want to say quick, because every time I say quick or brief, it always turns into a marathon. So I just want to let you all know that because of today's launch with everyone coming in and the the excitement and fanfare of everyone trying to download everything at one time, it slowed my ability to prep and prepare for this evening's review. So my charts are not as finished as I would like them to be, but I'll fill in the gaps as I go through with my commentary. I do want to try to be a little brief in the delivery, only because I'm going to do another video tomorrow. So you'll get something in addition to, because I don't like what I'm giving tonight, but there's no way around it because of all of the administrative tasks I had to take care of today to help quiet the nerves of the new students that were coming in. They felt alarmed that they weren't able to get the content, and all it was just too much traffic coming in at one time. All right, so before we get into it, let me just state that it is advisable for you every single time you watch a video, every single time you watch one in your study journal, write down the date that you finished it and any questions you had that may arise from watching it. And what you want to do is, in the forum where the link is for it, you want to take your mouse on your computer, and how you would do this any other way, like if you're using an iPad or something like that. I don't know how to download it for that type of device, but for a computer, whether it be laptop or desktop, to download the videos so that way you have a growing archive. Do not store them on online cloud services, the Mega thing that I have always been having my staff pull those links down. People that have tried to share my stuff before. Don't put anything like that on a Google Drive, because we eventually find those individuals that do that and we rip it down. And we also don't want you to lose your account, because in your mind you might be thinking it's a harmless way of storing the information, but it's not. So what we advise for the new students that are coming in, and for those that are considering it now, because the library is growing incredibly, so if you get yourself some flash drives, get a couple of them, like 3 or 4 of them, and you want to download them and save them on the flash drive. Then once you get a flash drive updated, copy that flash drive and keep putting that additional backup flash drive in a safe place. Also, you want to have a steady but consistent routine of consuming the information. Do not treat it like Netflix. I already have emails from people saying, I've already watched all of the videos, and it's no way they retained any of that. Okay, so take your time. You're going to see, once you start going through the commentaries, there's a lot of videos, and it just keeps getting bigger and bigger as you go through the mentorship. So just slow your roll. Don't go so fast. I promise, if you do what I tell you to do and avoid the things I tell you not to do, you will get here. It'll be more enjoyable. It'll be fun. So with that said, let's get into this one. Usually this is what I open up with. I give a general overview of what we're going to discuss. Usually it's the same 3 pairs here: the dollar index, euro dollar, pound dollar. And then if there's a lesson or a lecture discussion, then I'll include it here. Today, I want you, especially the new students, I want you to be looking at your lower time frame charts, okay, and try to record the things that you know right now, okay? Now, in the beginning, you might not know a lot, and that's fine. But if you store this stuff every single day in your study journal, at the end of each week, at the end of each month, when you consume new information and you learn more, your charts are going to be becoming more annotated with more insights. And the way you're going to test yourself is you're going to look at what I share in mine. Okay, now this is something I haven't been doing up until now. If this portion of my mentorship gets abused by sharing screen captures of it with your friends and such and putting them in chat rooms and things, eventually I do find that, because people will rat you out. And then once I find your watermark, and then I go through the process of whittling out who you are, and then you're removed. Okay, I shouldn't have to repeat this stuff, but I have to do it so that way you know coming in, this is where I stand. It may take me a little bit of time, but I just, right now, today, removed 3 charter members. 3. They paid all the way up to that point, and now they don't have an account with me anymore. And they don't get a refund, and they don't learn where I'm taking the group now. So it's unfortunate. They test it. They think they're going to get away with it, but eventually it happens. There's no honor among thieves. Trust me, if you sell my stuff or if you share it, somebody invariably is going to come to me with it. And then I work with them on the sly, and I reward them privately for helping me find the persons that are in here, okay, that are leaking it and sharing it. This is my life's work. I work very hard at doing this, and I sacrificed a lot to obtain it. And I don't think that it's asking too much for you to have that measure of respect for it. All right, so let's get on with it. All right, for the benefit of the folks that are new, I usually open up with the economic calendar. Sometimes I don't, depending upon what the week looks like, but this is an FOMC week. We had FOMC today. So everything Monday through Wednesday now is no longer salient. So what's remaining for the remainder of this week is Thursday, we have high impact GDP for dollar at 8:30 a.m. That's the New York session. And medium impact unemployment claims tomorrow. So we should see some volatility in the New York session around the 8:30 mark. And then 10 a.m. we have medium impact for the dollar, leading index. So on Friday, we have medium impact German preliminary GDP for euro at 2 a.m. That's London Open. And at 8:30 a.m. New York Open, Canadian dollar medium impact GDP number. All right, so again, for the folks that are just now starting, this is the part that I refer to all the time in my YouTube channel as the work. Okay, these are the things that you are going to be doing while you're in here. You're not just watching my videos, because you will not learn just watching. You might hear things, you might learn buzzwords, and you might agree when I point to things, but you won't see them before I point to them without doing this part of it. Okay, so this is the legwork part of the mentorship. Folks that don't subscribe to this practice are the same ones when they become charter members that will say, I just don't know what I'm looking for still. I don't know what I'm doing in my charts. I don't know what I'm supposed to be finding, because they didn't do this part here. So because this is my last mentorship group, this is my last, hurrah doing it, I'm literally going to walk you through the process of doing it. But I don't want to just simply say, here's the chart, there it is. I want to give you the opportunity to try to study it and use it as a homework assignment. So this video has a little bit of discussion as to what it is that I'm trying to get you to do, but I won't be doing this each time, okay? So just make sure you pay attention to this video and listen to the instructions I'm giving you, because it will pertain to every video going forward when we do midweek and weekend edition commentaries. I will generally show you a time frame. The time frames are daily, hourly, 15-minute time frame, and then now I've included the 5-minute, because I want you all studying the intraday volatility and the delivery of the daily range on that 5-minute chart. You're going to discover by doing this every single day, doing it up on your own, and then compare and contrast what you have with mine. It's not to say that you should have everything that's in my chart. Over time, you will start getting that way. But in the beginning, do not, especially if you're new, do not be discouraged. Do not feel confused. Pattern recognition and repetition of me doing this every single daily entry, every log entry I'm sharing. I'm doing it on I guess it's 2 times a week. So, but you're going to see my Monday, Tuesday, and Wednesday charts. So the things that are salient to me in price action, that's what I'm sharing with you. Because I'm showing it to you repetitively over and over and over again. And I'm also giving you an opportunity to look at the blank chart like I have here. You are to study this blank chart, okay, and annotate this in your own chart. So try to make your own chart kind of like as close as what you see being depicted here. So scale the chart the same way, make it look like what you have seen in my examples. When it's blank, when there's no annotations, no markings, no lines, no little scribble marks or anything, when it's blank, that's where you're studying, okay? And then when I move forward in the video, in other words, when I show the next slide, it'll have the annotations in the chart. And then what will happen is you will start feeling more confident over time because you're going to start seeing things that I'm drawing special attention to. And then because of that, you're understanding while going through each new month's content and each new commentary and me pointing to where I think the market's going to go next. All these things will work together and your learning curve will be shortened. Will it be perfect? Will it be without adversities? No. Everything is going to be dependent upon how much work you put into it and how much flexibility you have. Because if you're rigid and you're saying, okay, I need to learn everything that's supposed to be understood in the first month by the end of February. If you think that, you're really placing too much pressure on yourself. Don't do that. But just relax and go through the studies, and you'll see what I mean by going through this particular video here. I'll show you what it is over time that you'll start seeing in the chart. It's not important for you to know what a BISI is or a SIBI or anything like that while watching this video. But you can search for those topics in the forum. So the forum has a search tab. If you click on that and put in the things that you see in my chart, it'll take you to the areas in the commentaries where those particular things are actually discussed. So that way you don't feel the impulse to want to send me an email where I'll tell you it's taught in future lessons. Okay, because 99.9% of the time, that's the thing I'm going to tell you. All right, so I know you're all eager to get into here. He's already doing a whole lot of talking, and it's the first day of school for you as new students, and those that have been here for a while are being prodded to do these things that didn't. Okay, so yes, there's people in the 2016 group that did not do this legwork. Okay, and I'm trying to make them see the benefit of doing it through this entire year. So it gives them an opportunity to do with the new group the whole entire mentorship all over again, but with me kind of like holding your hand throughout the process. All right, so here's the daily chart for the dollar index, okay? And it's naked, it has no annotations in it. If you're not ready, pause the video because I'm going to start showing you the annotations now. All right, so for the benefit of those that have been here and have been watching this, we were looking for these levels up in here. This dashed line and this dashed line here is the optimal trade entry levels respective to this high and this low. The weekly fair value gap levels are annotated in that heavier dark line, and then the discount to premium level. We were looking for it to drive up into that in here, but it ended up falling short of that and it started consolidating. I placed a filter, and this was respective to the algorithm. So IPTA, I did not want to see Thursday's range violated. Initially, we were looking for it to run up in here, and then I changed my mind and said, okay, well, you know, we're going to look for the continuation on the dollar going lower. And then it just consolidated and didn't do that. So I gave a filter for Thursday of last week. I did not want to see Thursday's daily range violated. So here's Wednesday, today's trading, Tuesday, Monday, Friday, Thursday. We violated Thursday's high right here on Monday. So that sets the stage for what? Resuming the idea that it was going to trade up into this premium level. Now, premium is something you'll learn in the PD array matrix and how to frame a visual representation of what overbought, oversold is without indicators when we're working within a range. Okay, so a dealing range high here and a dealing range low here. And I know this seems like I'm going way too fast and over your head, but I promise you all of these things are taught to you, but you cannot absorb them all in the first day, the first week, the first month. It isn't going to happen. But trust me and follow along in the process, and it'll start making more sense to you, especially if you work your way backwards in the commentaries. In each day, if you can find the time to do one lesson and then one commentary, if you do that, you'll be able to digest a really healthy amount of information and not inundate yourself and overflow with concepts, because you won't retain it all. Even if you're taking notes, it's just going to feel like, man, this is too much. Take your time. So Thursday, on Monday, that Thursday high was violated. So that set the stage for the filter. And you'll hear me talk about this in the previous commentaries, last weekends in the previous midweek review. So you'll see where I got it wrong and we had to adjust. And then I gave you a filter in that recording. There's going to be videos where you see sometimes there's a mistake, okay, where I don't bring the video together and there's like a small little space in production where it doesn't show any video or audio. Every single time I put a video up, okay, remember this, folks, this is your first day for the new folks. If I make a mistake, the mistake is there. If I call it wrong, it's in there. I'm co-signed. I'm right or I'm wrong. Okay, you judge me over time, not by one day, not by one weekly commentary. You judge my ability to point to the next thing over time, and you'll see that we're pretty consistent around here. But I admitted up front, and my group knows this, in January, I am not trading. I don't trade until the first trading day of February. That's like this every single year. But because I'm on the hook, I have to do this every single week with you all as students. So I have to outline and gun to my head tell you what I think is going to happen. You go back and watch the previous recordings the last 2 weeks or so, and you'll see the uncertainty that this environment has created, and it's typical in January. It really is a month that doesn't do a whole lot. I was expecting a little bit more information to be utilized because of the U.S. election, all of the uncertainties about it, and then finalizing it on January 20th. There was hopefully some kind of volatility that would come into the marketplace, and it didn't. So with that put aside, we resume back to it's a nothing burger, if you will, or non-event month for the remainder of this month. But I thought that by going up into this area here, it would try to press up, come off this low a little bit, and not necessarily be calling the low in dollars. So in other words, I'm not trying to pick the bottom here. I'm just indicating the likelihood of it wanting to retest this area up in here, because there's a lot of things you're going to learn about in this mentorship that I have annotated here. But basically it's moving from an oversold to a short-term overbought. That's what I anticipate, and there's no indicators here that needs to be utilized to frame that idea. So with Thursday's high being breached on Monday, that means the likely scenario, the volatility expansion for this particular week should be on the upside if last Thursday's high is violated. And we're going to try to draw up into this area here. Okay. With that said, we had FOMC today, and the market did in fact make an expansion higher. So the move of this week so far, the largest range is what? On the upside. So on Monday, we had our indication given to us that Thursday's high was breached. So daily bias switches to what? Bullish. So everything on your intraday charts should be looking for a higher dollar. What does that mean for your euro dollar and British pound? Generally, it would be lower prices for euro and lower prices for British pound. When we get to British pound, and you can also confirm this in the previous recordings, I have been hands off on pound because I felt that it was reaching up into old highs to keep punishing those individuals that are trying to sell it short. And we'll talk about that in the British pound portion of this discussion. So let's go to the next time frame. It's the hourly chart. All right, and if you're not ready, pause the video before I show the annotations. All right, so here's the hourly chart or 60-minute chart for the US dollar index. So we had all this sell-side liquidity that left it in here. The Monday's trading, Friday, Thursday. Thursday's high being shown here. We traded through that on Monday. So that sets the stage for what? The volatility on the large end, or the magnitude of the weekly range expansion, is going to be to the upside if Thursday's high is broken or was to be broken. Before I go any further, let me tell you the reason why I said if it was going to go above Thursday's high, because I know some of you are saying, well, why did you say that, ICT? This is how this mentorship works. I get a feeling that you probably hear me talk about something and you want me to disclose it. Sometimes I won't, because it's usually a lesson that needs a whole lot more framework. But because it's your first day, I want you to understand that there's algorithmic things that we look at on Thursday. And Thursday usually caps the weekly range. And because I'm anticipating a specific criteria of seeing the movement on price expand out. I don't want to say breakout, because breakout kind of implies that I'm guessing. No, there's a specific level I'm looking for. It was Thursday's high, and it's relative to the idea that the algorithm uses Thursday to cap the weekly range. Now, if we have a down move on, say, for instance, euro, if euro's going lower and we made a high of the week on Tuesday, I anticipate most of the time, not every time, but most of the time, the Thursday New York session will create the low of the week. And it might go a little bit lower on Friday, but most of the time you're going to learn that Thursdays generally cap the week. And Tuesday makes the opposite end of the range. Not all the time, but that's usually what I'm anticipating going forward when I'm bearish. If I don't get something to sell off on a Tuesday, then I'll look for the same criteria on Wednesday, but I'll expect a larger, faster move on Wednesday going into Thursday's New York session open. Okay, and then maybe they'll bleed into Friday's trading and go a little bit lower. But generally, Thursdays make the opposite end of the range. And you can see that pretty much being illustrated here on the dollar index. You can see here's Thursday, which is the 21st. We trade down, create the low of the week, doesn't go any lower on Friday. You notice that? And then here's Monday's trading. So if we trade above Thursday's high, that to me indicates that there's going to be a change in the delivery. Okay, so when there's a change in the state of delivery, and you can look this up in commentaries. I just recently started teaching about that. I think it was this month, in fact, I think it was, or if not, the last couple weeks of December going into January. I'm almost certain it was December now I think about it, but you'll have to take a look at the commentaries and where it talks about the topics or lectures I'm talking about in those particular videos. It gives you a little like a bullet point, tell you what it is I'm lecturing about in those videos. The change of delivery, okay, is basically just another way of saying a short-term change in direction. All right, but I'm giving you the industry standard terms that you don't hear in books, because everything in books is retail. So you have a change in state of delivery from bearish to bullish. So if it's moving bullish, and we know this on Monday when it trades above Thursday's high, which is here, anything as a decline is to be viewed as a opportunity to buy, because the market's going down into a discount. Remember the daily chart? I had that red line. I had discount and premium. If we look at the low to high, that's our dealing range in here. Midpoint's about in here. I'm going to eyeball it because I didn't want to add it to the chart and have more lines than is necessary. But we went down below it, so this means the market moves to a discount. I want you to take a look at this last down close candle here with the lowest down close. That is your bullish order block. It has a small little gap in here, right there. So you're associating two things that make up a strong bullish order block. I'm going to give you something that all of you are dying to know, and it's probably the first thing on your list. Which order block do I buy? Which order block do I sell? When you see a small little gap in here, which is what you'll learn about when we go into more lessons, and you have some of them available to you in the commentaries. You're going to find that the commentaries are where the mentorship really is. Those lessons at the top of each month, those are just foundational. They are not the mentorship. I could literally put those videos on my YouTube channel and nobody would know what you're learning in the commentaries. This is where it's all at, because I'm doing it in live market environments where it's before that stuff happens. Whereas those videos are just conceptual teachings after the fact. So I'm putting it to work and using it to call future moves. So the market goes to a deep discount here, basically a short-term oversold. Okay, so when we say discount, just think of it as what you understand as oversold. And when the market goes to a premium, that's which is collectively viewed as retail overbought. But you don't want to think overbought and oversold, because that will get you in trouble, especially if you don't understand what you're doing within a particular market, because markets can stay overbought and oversold and still keep on moving. And if you don't understand institutional order flow, which is what you learn here as well, you'll fall victim to those retail ideas. But you'll learn also how to use that retail idea against the market participants that think like that. And that's exactly what smart money does. So the market trades down into this last down close candle, bullish order block. When we get in the lower time frame, 15-minute chart, you'll see there's a fair value gap there. It trades right into that, and then the market creates an opportunity to go higher, runs into the buy side liquidity. Now, buy side liquidity is, think about it, any old high or relative equal highs, that is where buy stops are going to reside. They're going to be using that area to think of it as resistance. And traders that are going short here, okay, they're going to have stops right above that. The stops that are utilized above a high is a buy stop. They're using it to protect a short position, because the idea is if it goes up there, they don't want to ride something that continuously goes higher and have, you know, an unlimited amount of loss theoretically, or until they're margined out. So above old highs, it's buy side liquidity. Below old lows, it's sell side liquidity. So what I'm doing in this process of showing you in the commentaries and discussing over my shoulder what I see in the chart, I'm training, even if you don't feel like it's happening, I'm teaching you and training your eye to see buy side liquidity pools, sell side liquidity pools. I'm teaching you the PD arrays. Now, PD arrays are specific things that I teach here. There is it's not a lot of them, but there's a number of them that exist in price that the algorithm will reach for, and I'll just name a few of them off the top of my head. Obviously, many of you know the order block. Many of you know the breaker. Many of you know the mitigation block. But there are fair value gaps. There's vacuum blocks. There is propulsion candles. There is the buy side imbalance, the sell side imbalance, and there's other ones that go along with that too. But the point is and rejection block. The idea of knowing where they exist in the context of the price action is what you learn over time being here, because of me pointing it out, showing you, and you start to get a rhythm and a feel for what it is that the market's doing. And what will happen is you will start having these annotations in your chart before you see mine. And that's how you test yourself. But do not be discouraged, especially for the folks that are new. It's unreasonable. It's unrealistic for you to have the expectation that the things that I'm showing you in my chart, you're going to have in yours. So don't be discouraged. Over time, you will see these things, and you'll start seeing it. And then you'll have the annotations in your chart, and then it'll get closer and closer to what mine look like. So we have a run up in price. The market consolidates, creates a down candle here, rallies up through the buy side liquidity pool up into the last up close candle, which is a bearish order block. A bearish order block is not necessarily an opportunity to sell short at. In this instance, it's a target. So the market's trading up into here. Now there's buy side liquidity resting above this high, just like it was here and here. So I'm anticipating Thursday into Friday that the dollar index could make another run higher and trade up into that premium level. Now this is that premium level that I identified and annotated on that daily chart. All I did was transpose those ideas and concepts that I'm looking for on that daily chart. I'm transposing and placing the same ideas, so it's a frame of reference on my hourly chart. So I'm not changing my mind because the candle's going up and down. I'm keeping everything in my mind relative to that daily chart and what I anticipate likely to happen, but also using all the little intricate points on the hourly chart along the way. So everything will start fleshing out and like a puzzle, it fits together. But you have to see this for weeks and months, and then you'll start seeing how they all tie together. Trust me, everything fits together perfectly. Going forward in the next time frame, we have the 15-minute time frame for the dollar index. Now again, if you're not ready, pause the video because I'm going to show you the annotations. All right, so here's the 15-minute time frame for the dollar index. This is a volume imbalance. Volume imbalance is that little separation between the body's close here and the body's opening. There's just wicks from this tail and this wick. So there's no bodies overlapping in between the opening price of this candle and the closing price of this one. That is what I teach as a volume imbalance. It's the same thing as a real gap. Okay, so if there was an absence of any kind of trading between a particular price and another price, that gap is what everybody knows as a common gap. This doesn't show a common gap. It shows just a wick and a tail in between these two price points, the close of this candle and the open of that. That is a very sensitive point of price. It's algorithmic, and it will literally reach back into that level right there in the future. Bang. See that? Trades into it there and then starts to rally. We have a high, the low, and a higher high that runs out to buy side liquidity here. Here's that Thursday's high. Remember, I was telling you that I gave in previous commentaries, last weekend's commentary, before the week started. I said if we trade above Thursday's high, then I'm going to go back to thinking that the dollar's going to go higher. So any discount, we want to see it as a buying opportunity. Here's that little fair value gap I mentioned on the hourly chart that we would see clearer on the 15-minute time frame. The fair value gap is defined by this candle's high and this candle's low. So it's one candle going up in between those two price points. You can find more information on fair value gaps and discussions in the commentaries as well. But there's lessons that are actually taught in the core content that help you at least begin to see fair value gaps. But you're going to see fair value gap all the time in commentary, and you're going to see what they look like, how I use them, what's the benefit of them, when do they fill halfway, and when do they just go into the top as a institutional order flow entry drill. There's lessons around that. So anyway, this is a buy side imbalance, sell side inefficiency. That means that it's just one single candle. It's a larger version of this, just extended over a larger range. Okay, so basically, buy side imbalance, sell side inefficiency is the same thing as a fair value gap, but just over a larger price range. Same premise behind it. It's just one single candle that passes through two specific price levels and no counterpart movement lower, or in this case where the market went higher here. So all of this price action here is being held up by this one single area here and in a small little point right there. So it finally collapses and goes back down to a discount, or in retail terms, oversold. Okay, we don't need to see an indicator to tell us it's oversold. If you plotted an indicator that was oversold, overbought on here, it would get probably close to these areas. But we are not looking at just overbought, oversold. We're looking at areas where the market is inefficiently delivered, and it will go down to those levels perfectly and then give you a bounce. It fills in this little area in here. But this breaker here, you can see that traded to here, and then it trades down into that fair value gap. So we got really deep discount pricing there on the 26th, so during Tuesday. So Tuesday creates the low of the week thus far, rallies up, it comes back down in. Consolidation one more time into an order block, volume imbalance, trades into it here, rallies up, buy side imbalance, sell side inefficiency. In other words, it's created an imbalance here, too fast one-sidedness. And the next candle here that closes the buy side imbalance, sell side inefficiency top end. In other words, the boundary that creates the high end of it, whereas this is the low end of it here on this candle's high. The very next candle that drops down into this area here, that is what I teach as an institutional order flow entry drill. It's a way for you to enter a trade in a market that's already started moving, and you're not chasing price. You're not chasing price. Now, there's two ways you can do a study on the commentaries to learn about this one here. You can do the search tab on the forum and type in IOFED, and it'll pull up lessons in the commentaries that have that. Or you can simply type out the words institutional order flow entry drill. And if you do that, you'll actually get the very first lesson where I started teaching those as drills. And you need to be doing that, even if it's in hindsight. If you do that, you're going to start seeing how it's easy to follow institutional order flow, and you don't need to have the best entry here, here, or here, or here. You can buy in it here, and you have all the logic back here that says, okay, I don't need to be fearful of it coming down here to stop me out, or down here to stop me out. You understand what I'm saying? So I teach you ways for you to participate in market moves in various forms, and you can have the most precise entry points, or you can wait a little bit and get a little bit more confirmation, and this would be like a conservative entry point because you know you have buy side liquidity up here that's going to attack. Remember, all of this move here was set up as a run higher if we went above Thursday's high, which is what we did on the 25th. And on the 26th, we had a deep dive going down into the New York session where we had a market reversal profile. And then we consolidated going into the Wednesday's trading. We had a small little Judas swing, which is the little move that happens at the beginning of the day into London sometimes. It trades down lower, bullish order block, volume imbalance, starts a rally, creates the imbalance, institutional order flow entry drill. So there's an entry technique right there. You can go long. This is another one here. It's this right here is the same thing with this candle right there. I just don't have it annotated because it's too much on one chart, especially for the new people coming in. But this is an institutional order flow entry drill as well. So you could have been a buyer here and ride all this up into that 15-minute order block. Now, I don't have the 15-minute order block in the chart. For your homework, you can use these two reference points here to go back in time on the 15-minute time frame, and you'll see that little up close candle that this is basically drawing attention to. And above this high now is buy side liquidity. So the market drops down into the fair value gap here and just about completely closes it in. Didn't quite get to it, but very close to it. The market rallies back up to the bottom end, well, just short of it. And this fair value gap here, you can see the market runs from here up into it, just fell short of it there. And it'll be interesting to see if we trade above that. If we come back down into it, now think about what I'm telling you here. If we trade above it, it is this little area here, these lines extended out in your own chart. If we trade above it and come back down in, that would be a buying opportunity for me as well, because that would be basically looking at this as a mitigation and a fair value gap being utilized as a support level. And that would be something I would look for to support a price run above here. Okay. All right, finally we got the euro. So here's the daily chart. If you're not ready, pause the video. All right, so here's what we have here on euro. The same thing I mentioned for euro. I had the algorithmic filter on for any price movement that went below Thursday's low on euro sets the stage for this going lower, and I'm aiming specifically for this fair value gap right there. So we have this candle's high there, and this candle's low right there. And this one candle only traded between this candle's high and this candle's low, one directional. You see that? One direction. That means this was buy side delivery. Buying only. The price went higher, okay? So that means all this price action is being supported by this one single little area of inefficiently delivered buy side. What do you think the likely scenario is eventually that should take place in this? If it's efficiently delivered, the market should trade down into this area here. So trading down into this area, and this is also a bullish order block. So, and it's also a weekly fair value gap. So what we're showing here, this little area right there, that's a fair value gap. This low and this high, if you look at a weekly chart, you'll get this same thing here on this one candle. It'll be one weekly candle creating this same thing. So that's what I'm annotating here, a weekly fair value gap. So the range is being defined as such. We had a breaker in here. We worked off of the mean threshold of this bearish order block, and admittedly, like I said, I didn't have any real clear indication of what I felt the market was going to do. I just gave Thursday's trading and its low as a filter if it traded through that. So with Monday's violation of the dollar trading through its Thursday's candle, that sets the stage for a lower euro. So we can utilize just that. Now, you only need one of these markets to give you that. So if I say in a commentary, I don't want to see price trade above this market's candle on this particular day, and then conversely, I'll say I don't want to see the dollar index trade through this candle that particular same day. Okay, if either or happen, the filter becomes active. Okay, so in other words, thing that I'm looking for as a result or an event, should these things come to pass, one or the other, they don't necessarily both have to happen because there's cracks in correlation sometimes. So we might not see the euro trade through its Thursday's candle, whereas the dollar on Monday traded through its Thursday's candle's high. So it forced the filter that I placed in the previous commentary in effect. So higher dollar, lower euro. Okay, so that's the basis behind that, and we're going to move into the hourly chart. Again, if you're not ready, pause the video because I'm going to show you the annotations. All right, so we had a buy side liquidity pool in here, small little residing fair value gap right there, didn't quite fill in enough. overshot it there. So we had buy side liquidity taken, imbalance rebalanced here, and trade up into it one more time. Last up close candle, bearish order block, it trades lower, creates a sell side imbalance, buy side inefficiency here. So it's basically like a fair value gap with a down candle. Okay, it's defined by this candle's low and this candle's high. And this right here is an institutional order flow entry drill. I just don't have it in the chart because it would be too busy in the chart and too many things being pointed out for the new people. This is probably already too much as it is, but you know, you got to come in here expected to learn, and you're going to get a lot of information, and you have to do a lot of homework and note taking. But this is an opportunity to see it sell off here, and then it sells off lower, taking out the Thursday's low. So taking out Thursday's low is the algo filter I gave you in the weekend commentary. It does so here. Any rally sets the stage for what? A sell-off. So what is it going to do? It's going to go up into this area here, rebalance that. Look at all the bodies of the candles in here. Okay. Yes, we have a wick that goes through it here, and a small little wick that goes above it, above this fair value gap. But this wick only reaches up into the order block, this last up close candle that has the body on it. So you always anticipate that as a likely scenario, but the bulk of the volume, the majority of all the trading institutionally is right here in this shaded area. You see that? This is a signature that we like to see. We like to see this very thing happening. Then the market trades up into half of that gap, or fair value gap, trades there, and then breaks lower. Sell side liquidity is attacked there. On the hourly chart, you can see that the breach of Thursday's low is here, right there. At that point, any rally up sets the stage for the market going into a premium. So it's this low to this high. There's your dealing range. So if we go above halfway of that, that would be a market that is considered at a premium, or would be referred to as a overbought market. By itself, it doesn't mean anything, but when you compare it with areas like this, and it's overbought, or it trades into an order block like this, that means something now. So now you're blending two things. You're blending time and price. Time and price. Where is it at in reference to this low and this high when it's trading here? It's in the upper half of the range that would be defined by this high to that low. So this is overbought, and we don't need an indicator to tell us that it's overbought. If that criteria is met and it trades to a PD array, which in this case here is a SIBI, sell side imbalance, buy side inefficiency, that is the same thing as a fair value gap. It's just over more range, more pips. Okay, you're going to find sometimes I use them interchangeably, and this is a matter of thinking about it in relative terms to all the price action around it. So this could have very easily been identified as a fair value gap because the parent PD array or category for it is fair value gap. Underneath that category, you have a sell side imbalance and a buy side imbalance. So it's BISI or SIBI. Buy side imbalance, sell side inefficiency is one single candle up. A SIBI is a one single down candle, sell side imbalance, buy side inefficiency. And what it means is it was only selling here, and nothing until the market went up here offered buying. So in other words, the pass through on this is going lower, and it passes back up in that same area here. So it efficiently balances the range between this candle's low and this candle's high, because it offered delivery of price on the downside as it was dropping. But what happens if you wanted to buy it? You didn't get a good chance to buy it because it was moving only one-sided. So over here, the algorithm goes up in that same range, and it offers buyers opportunity to buy it. It does not mean it's a good place to buy, and it does not mean it's always a good place to sell. It just means that this is an inefficiency, but when you put it inside of the narrative that Thursday's low was taken out here, and it rallies up to an overbought condition, and it has a PD array that's a premium or considered overbought, then you're blending two things, time and price. And when that happens, you get these types of results where it attacks this low and trades into this. Now, this is something I just taught in the last teaching or last commentary. And this is talking about rejection blocks. And you'll learn about rejection blocks, I think, if I'm not mistaken, it's in month 4 content. But just so you know, the rejection block is the down closing price inside of a swing low. So we have a swing low right here. Okay, that closing price is the rejection block. Then you have a lower low. I taught just recently that if you have this situation here where you have a low and then it's violated with a lower low and then it runs away, you use the first low in the lowest down close. That's your true rejection block. The market trades down into it, doesn't go below this low or below this lowest down close. Notice that? And then it had this retracement up into the bearish order block. So we're going to see if it, after it's already closed in this small little fair value gap there, look at the bodies in here. So we're going to see if it has a willingness to go lower and attack that sell side liquidity. Because if we're going to see higher prices in dollar, and if that is in fact what happens, because there's no perfect track record. I don't have 100%, but I have to tell you what I think is going to happen. And if I'm wrong, I'm comfortable because I'm not trading in January. But as we get closer into the February and deeper into the February, you'll see that it's a lot easier, or it should be a lot easier to read price, and I'll be a lot more confident in what I think is going to happen. But right now I'm saying that I think that Euro may attack the sell side liquidity here. Okay. All right, and finally the 15-minute time frame isn't going to have a whole lot on here because you'll see that the 5-minute chart will have all kinds of stuff. And here is the sell side liquidity pool, and we ran into that. Now again, I want you to study. This is not a rejection block by a specific price. I just put this in here as a means of reminding myself to encourage you to go through and look at all the down close prices in like a 4-hour chart, a 1-hour chart, and a 30-minute chart. Go through all the different time frames that are available to you and study all of those prices in here and see what type of sensitivity you have. And you'll see that that hourly one is just beautiful because it's framed on the idea of the low that has a lower low and then the price runs away. That's a stop run, okay? Or as we teach it, a turtle soup, which is not turtle soup specifically out of the Street Smarts book by Linda Rasch and Larry Connors. The name just caught on because it was inspired by that pattern. But if you read their book, you'll see that I don't teach that pattern. I just understood stop runs because of that book in 1995. It made sense to me when I saw it. I don't use count 20 days, look back. That's not all I need. Okay, it's a good framework to start people there, like I did with Baby Pips. I encouraged everybody to buy that book when I went out there and was teaching stuff. But I don't use that idea of just looking at the highest high in the last 20 days or the lowest low in the last 20 days. That's not what I do. I'm looking for specific things and specific narratives inside the price, and just study that in here on all your time frames with the 15-minute time frame. Okay, in other words, not using just 15 minutes as the chart of study, but you want to go through the 4-hour, the 1-hour, the 30-minute, and 15-minute time frame, and use all the lowest down close prices in this area and see how many times it trades to those particular price levels. And you're going to see, again, like I mentioned a minute ago, that 60-minute chart was just the beautiful one. It's just nice. All right, this is what you're going to be doing. This is the legwork as well. Every day you want to look at your 5-minute chart. So around noon time, well, noon is over here. This is 2 o'clock in the afternoon. That's about as long I want to watch price. I don't care anything after that. And most of the time it's at 12 o'clock that really finishes it for me. So we had FOMC today at 2 o'clock in the New York time. So that's here. And I don't want you to think about this time frame all that much. I want you to be defining your days with noon to midnight or midnight to noon. Okay, and that's going to be the lion's portion of the daily range. And everything that you frame out in your chart, you want to keep that within that context. All right. So on Monday, we had the violation of the dollar index trading above its previous week's Thursday high. So that set the stage for lower prices in euro. So here's Monday's trading. Market trades up into a rejection block and London open kill zone. This is not an indicator. I physically draw this in a rectangle, and the times are 2 o'clock in the morning, New York time, to 5 a.m. New York time. I just make a rectangle that's big enough that I can type in this, okay? And New York is 7 o'clock to 9 o'clock in the morning, New York time. And London close is 10 o'clock to noon, New York time, all right? And I just lay these in areas to annotate it to you. I do not have these on my chart when I'm watching price. I'm aware of what price is doing within these time frames. I'm looking at the time axis down here, so I'm aware what the market's doing relative to that time of day. So we have a sell side imbalance, buy side inefficiency, single pass through down candle here. Then we have an institutional order flow entry drill. And all this is, so I know some of you are dying to find out what that is because it's an entry pattern. Oh my goodness, ICT just taught us how to find entry patterns. All right. On my first day, I learned how to do it. Please don't go in there and start trading with live funds, folks, because you don't know what you're doing yet. But this candle's high and this candle's low. If it trades back up to that candle's high, which it does here, or above it, you can go short there. It doesn't need to come all the way back up and touch this bearish order block or fill all this in. In fact, it's better if it doesn't, because it shows in a very clear graphic depiction of heaviness. It wants to go lower. And then once it starts to trade lower, it happens again. We have a small little fair value gap there, defined by this candle's high. If it trades that candle's high, it does here and here. This is an institutional order flow entry drill as well as this one is. And you can sell off there. It's not a lot of pip, but if you're looking for 10 pip runners that you can just scalp all day long for practicing, it's just a beautiful little way of doing it if you know what the market's reaching for. So this is a mitigation block also. It trades back up into that within this fair value gap that did not close until here. Look at the bodies of the candles. Yes, we have little wicks above it, but look at the bodies respecting that specific gap right here defined with this fair value gap. Beautiful delivery price. Trades off lower, come back up, bearish order block, small little imbalance here, hits the bottom of the fair value gap and breaks lower. Retrades, consolidates, breaks lower, retrace, breaks lower, bearish order block, mean threshold there, sells off, attacks the sell side liquidity here. What's sell side? The opposite of what I explained earlier in the video. Above old highs is buy side liquidity or buy stops. What's resting below this low here? Sell stops. Why? This market started to go higher. Somebody's long. So how do you protect a long position? You put a sell stop below some particular price level. What do you learn in the books? Below the low? Well, that's what it's running into here. And it's trading into the optimal trade entry levels relative to price action that you can study and figure out what these are here. If you watch and look at the previous discussions in commentaries, you'll start to see where these are. Okay, but this is what I want you doing and practicing. And the London close is 10 o'clock to noon, and that's usually when it makes the opposite end of the range. Okay, so you have London creating the high today. Well, specifically back here, but it does create almost the equal high here. Sells off, continuation in New York, opposite end of the day, daily range between 10 o'clock and noon. Many times it's going to be between 10 o'clock and 11 o'clock New York time, but the window I teach you is 10 o'clock to noon. All right, so these times are static. Don't move them around, and you'll see they pretty much serve you all year round. And the market trades off those lows and consolidates. All right, so here is the trading on Euro in the 26th of January. So this is Tuesday's trading. So the market trades lower, below the previous day's low. We have buy side liquidity here. The market rallies up, creates a small little imbalance here. Buy side imbalance, sell side inefficiency. So one single up candle, to be balanced efficiently, it should have down movement into the same range. It does so here. Almost completely closes it in perfectly. Not quite, but it's enough. Then the market comes back down again, and one more time into it, finds some support, runs. We have a mitigation block here. You learn about mitigation blocks in month 4 content, and it starts to accumulate in here, rallies up, optimal trade entry during New York session, rallies up, institutional order flow entry drill, because it only goes to this candle's low or lower inside of this imbalance. You can be a buyer here, scalp it, run up into target here. This line right here, all this is looking at the bodies here and here for optimal trade entry. There's your buy. It rallies up and hits that perfectly. That's for your study. See what I'm showing you here in your own charts. And I'm using the framework in this here for optimal trade entry, and in the same settings I use in my YouTube channel for the fib extensions, that's this level right here, and it calls it pretty close. It doesn't get the exact high, but that's really close enough to impress your wife or your husband. So the market creates a small little fair value gap here, and again, this is a institutional order flow entry drill as well. This is consequent encroachment. Consequent encroachment is the midpoint of any imbalance. Okay, so the imbalance here, the midpoint of that, like for instance, if I teach a order block, you all know, because if you've been watching my YouTube channel, midpoints or half of an order block is what I teach as mean threshold. In gaps, which is an inefficient delivery here, or in wicks and tails, I teach the midpoint is consequent encroachment. Okay, that's the midpoint, what is acceptable without filling the entire gap or imbalance in. Midpoint is usually very sensitive. This is an institutional order flow entry drill technique here. You could be a buyer here and get 10 pips out of that run there to get to that target. So you had a target from here to here that could have been 20 pips. You could be buyer here to here and get 10 pips. And you missed all this as ideal entries. So as long as you have time, remember the first thing I teach is the algorithm operates on time. It hits the high of the day inside of London close. So in here, this one's not as favorable as this one because this is outside of the time window of London close. This one's more likely to deliver because it has more time in the day before it gets in this area where it generally creates the opposite end of the daily range. So here's London open creating the low of the day, and here's the high of the day forming in London close. So there's your two bookends that create your daily range. Your open, down, power 3, accumulate, buy, reaccumulate, buy, catch some small little entries to either add on to if you've already bought long, or just use them as scalps or practice and run into your target. And the market sells off, trades into the mitigation block, and then bounces in here. Finally, moving into today for euro dollar. Here's the London open kill zone. Again, now this is when the market has already traded up and we're looking for it to sell off because the dollar index is now bullish. The market trades off, creates a small little imbalance in here, fair value gap, trades up into that during London open kill zone. If you have a bias and it creates this optimal trade entry pattern right there with a fair value gap, man, is that like sugar. It's so good. That is in itself, that is a model right here. If you know your bias, if you know what it's likely to reach for, okay, as a directional bias, it's going higher, going to go lower. If you get this type of setup here, this is it. Like, that's all you need. You don't need to sweat everything else in this mentorship. You just need to learn what draws price to where, what directional bias, and time of day. If you see this pattern here, that's it. That is it. That's what makes an optimal trade entry really optimal. It's really, really sweet. And it's in the context of the criteria I set up for dollar in the previous weekend commentary. You want to also download the commentaries because you'll see that I do not go back in and edit anything. I'm right or I'm wrong. The things I say, I stand on. If I'm wrong, I'm comfortable with being wrong. It's not a lot that it happens, but when it does happen, there's something that you can learn from it. And this market has been very finicky in this month of January, and it's been lots of reasons for it to be like that. But it's just really encouraging to see when everything algorithmically unfolds, even in a month like this, in a time like this, in a period of just lackluster price action, when you see something like this, it's just beautiful, really just perfect delivery of price. Hits the top end of this low candle, in other words, this low on this candle, extend that out in time, trades up into it, fills in all of this right here. The one single down close candle, we have up close candle here. So it's balanced. There's no need for it to go any higher. How do you know it's not going to go to this level here? Because this is a signature that I teach, and that's what the algorithm does. It refers back to this point right there. It doesn't need to go up any higher, but your stop needs to be above this up close candle's high because that's your bearish order block. It could tag this body and go into a little bit, so your stop needs to be above there. So you could sell short in here, stop here, and look for the previous 2 days ago. Okay, in other words, this is Wednesday's trading, so Monday's low is here, this line. That's what I'm annotating. So you want to be always looking back 3 days. Count today as 1, yesterday is day 2 and day 3. So 2 days ago is what I'm referring to in this annotation. So it's 2 days ago's low or Monday's low. And this is Tuesday's low or previous day's low. So once we get down into Monday's low, yesterday's low, or Tuesday's low, we rally back up. And then what we're waiting for is the displacement. And we get it right there. See that? See how it energetically moves away versus something like this. This meanders and comes back up, yeah. But then you have this real nice push away. When it does that, that's the same thing you're seeing here in what time? New York. This is what your eye is going to be trained to see. You might see this as I'm drawing your attention to it now and saying, wow, I can see the similarities between this and this. It's one single down closed candle. It's one single down closed candle. It's an optimal trade entry, high to low, retracement. Optimal trade entry, high to low, retracement. It's got a fair value gap. It's got a fair value gap. It's a time of day. It's still likely to go lower. Where's it going to go? I have that line down here. Again, this is not the level I want you to look at. I want you to look at the hourly rejection block and how it trades into it here. I don't want you using this level. I just want you to look at all of the rejection blocks across all the time frames and see how that lines up on your 5-minute chart and how it presents the opportunity for calling at the low or very close to it. And then you have another institutional order flow entry drill. After the sell-off starts here, it gives you one more little fair value gap. All it needs to do is trade to this candle's high on the next one. It does it here. So you could be short there. Stop needs to be above this candle's high. Why? It's a bearish order block. And you frame out your whole trade. I'm giving you a ton of stuff, folks, right now. I have no doubt that 6 months from now, you're going to come back and look at this very first video and say, man, he gave us everything. Yeah, I gave you a lot of stuff right here. You may not feel like it, but I'm giving you all kinds of stuff. This is not YouTube, okay? So institutional order flow entry drill here, and then what does it run? Boom, slams into the rejection block. That's found on the 60-minute chart that I showed you on Euro. Once it hits that, you need to be canceling out all of your partials that you would have had and leave a small portion on if you wanted to see it go lower. But since it's FOMC, you really want to be chasing it down and taking out partials and considerable amount of partials. Only if you're practicing, you don't want to be trading ahead of FOMC on Wednesdays or days that have FOMC related things at 2 o'clock New York time. You don't want to be trading that day. But you can see here it works out really nice for practice and or study. Then the market trades off ahead of London close. Now, this is just one of those times where you want to be aware that it's likely to turn. You're going to find that sometimes it will turn at 9:15, 9:30, some kind of speech will come out, or it just hits a level that makes perfect sense, like that rejection block. And once it hits that, then you have everybody, moving to the sidelines on the institutional level, and there's no real interest at all. The algorithm will want to consolidate going into FOMC, which is what you have here, and then it really doesn't do much at all today. All right, finally moving into cable. I'm going to go through this one really quick because we have been hands off on this one. The long and short is on this daily chart, I've been saying it's going to go killing up higher, but just to knock out the stops. I don't want to trade this. I haven't been wanting to trade this for months. Even though I've called it higher, I've not trusted this pair. So I'm just going to go right into the annotations because it's not really important. I'm looking at this low to high. I think that the market could correct down below this low. And this is what I teach as a trendline phantom. After running the buy side liquidity here, and this is also a breaker. Okay, so we have a breaker in here. That level is seen if you go out farther back to the left in your own charts, you'll see what this level is. It's a very clear breaker. And this, I think, is the draw on liquidity if we continuously move higher in the dollar. If we get a real nice pop up in dollar, cable should have no problem getting down here. And if it does that, I'm not necessarily calling the top in cable, but that would really upset any trailed stop losses along the way, because we really haven't had any kind of stop runs since this one here on that low. No stop runs have occurred since then. All right, 60-minute chart. Pause the video if you're not ready for the annotations. All right, so we have a buy side liquidity pool here. This red line is the breaker on the daily chart. It's been transposed to the hourly chart. I mentioned that this particular market is going to keep punishing short sellers. I even commented on my YouTube channel community tab that cable keeps punishing everyone that wants to sell short. I think that it could have done enough work in here to see it trade lower. And we see this break here. We have a run where it's just a fair value gap delivery on the downside. So this one single candle gets rebalanced right there perfectly. Then we have a displacement lower. It reaches into here on this imbalance. That's a fair value gap as well. And then it runs up into this fair value gap. I counseled my students over the weekend to create charts that just show fair value gaps and keep the levels extended going to the right. And you're going to start seeing sensitivity at levels that would otherwise be unnoticeable to you or anyone else that doesn't know about what I'm teaching. They will act like real support resistance does in books. Okay, because the idea is support and resistance, it goes up to an old level, stops, turns around. If it goes back up to that same level, it's going to stop, turn around, right? Because that's what we're told. That's what the books tell us. But it doesn't always work. I've lost lots of money doing that. And if you look at how imbalances work in the context of price delivery, you're going to be amazed at how price really finds support and resistance on these levels. And what I'm referring to is areas where it's just one little single candle creating a range between the previous candle's high and the previous candle's low. While that's not being indicated here, this is actually a 15-minute time frame, and you'll see it when we get down to the 15-minute time frame. But if it was being annotated on the hourly chart, it would be this candle's high and this candle's low. But this is the 15-minute time frame, which you'll see. But nonetheless, it trades into the bullish order block with a fair value gap, and then you get this little pop up. Where does it go to? The imbalance right there. Then what's happening? It sells off. Remember those videos I was doing on YouTube where you were watching me trade intraday back and forth, buying and selling, buying and selling? It was using some of these things here plus algorithmic theory. Okay, so what do I think is going to happen next? I think that this little imbalance that's more easy to see on the 15-minute time frame will trade into this one and the order block. We might get a little bit of a pop there. I'm thinking it's going to go to the sell side liquidity there, and maybe if it gets really ahead of itself, it could trade down into this imbalance there. So have these levels on your chart, and we'll watch it going forward. Moving on into the 15-minute time frame. Again, if you're not ready, pause the video. All right, so here's that small little 15-minute time frame fair value gap that I told you would see clearer on this time frame. Sell side liquidity pool rested below here, so in other words, there's sell stops below that. We had 1, 2, 3 runs up above the buy side liquidity here, and then we have a break. Now, you all see high, low, higher high. That's the breaker, extended out in time. No, I see high, low, high, moves lower, comes back up, fails to go above this high, and goes lower on this low. It's the mitigation block. It's the down close candle. Yes, sometimes the breaker might overlap, but my concern is inside that last down close candle there. What do you do with an order block? It's the low, the high, and the middle point, or mean threshold. Find the mean threshold of the last down close candle in here, and bam, there you go. Mitigation at mean threshold. So it's the midpoint. Sells off, and we have what looks like an institutional order flow entry drill in here, but I didn't want to draw too much attention to that because I don't know really what this pair is going to do. I'm going to stand on the idea that I think it's going to go lower based on what I've outlined here and what I showed you on that hourly chart. All right, for Monday's trading, here's the 5-minute chart. This is my annotations, and this is what I'm sharing here. These are the salient points from Monday's trading. Now, you want to have your charts for each day on Monday dressed up before you see mine. Okay, so when we pass through the charts and we get through both Euro and cable, and then I go through the respective 5-minute charts, like when we do the weekend review, I'll show you Thursday and Friday's 5-minute charts for Euro and cable, just like I'm showing you here. So you want to have your charts dressed up and annotated before you watch my video, because I'm not going to show you the chart blank on the 5-minute chart. It just makes the video a lot longer. I want to make it more fluid. On Monday, we have the line open kill zone here. The market trades up, breaks down. So we have displacement, small little fair value gap there, mitigation. Remember what I was saying earlier? We have a high, low, higher high. You see a breaker. I see a mitigation block. Okay, and you'll learn about mitigation blocks in month 4. Consolidation inside of the fair value gap here, and then breaks lower. Extend it out in time. Right in here. Order flow with this mitigation block. Why? high, low, lower high, breaks through it. So it's this candle, the low extended out in time. So you have mitigation there. Look at the bodies of the candle. It's not going much above this closing price. We wick through it a couple times in here. This is all broker related. So your spreads is what is affecting this on your platforms. If you look at your live account, if you have one, your time on this candle here and match it up on your TradingView, because we use TradingView. And I didn't mention this earlier, and I apologize. I meant to say it earlier at the beginning. Those of you that are looking at month one content as a new student, you're going to see me having a discussion about what demo account to use. There's a broker that no longer operates anymore that we used for a demo account in the past. I don't want you to send me an email saying I can't access Forex Ltd, or I think that's the name of the place. But we don't use that. But because I don't change anything, I don't edit anything once I put it out there, I don't ever want to have, and I cannot have, and I will not have someone say, you went back and edited this video. I don't do that. So I make everything available like I promised in our agreement. Every lesson I gave in the past to the mentorship group up to this point, you are living those all over again. So when you see that video discussion about what broker to use for a demo account in month one content, disregard that broker. We're using TradingView, okay? TradingView, and we're using the Forex.com price feed for every currency that I'm pulling up. So euro dollar, pound dollar, we're using Forex.com, and the dollar index is TVC. That's the composite index that we use for the dollar from TradingView.com. So we have the mitigation block here, the dashed lines. You can see that being here. And it trades up to the consequent encroachment of that. Remember, just like the previous discussions. So it's moving halfway point there and then trades lower, comes back up, mitigation again here. Midpoint, about almost got to it here. So we have another optimal trade entry there. Doesn't quite get to the beginning of the New York session. So this one here, just a little too early, and runs lower, comes back up, bearish order block. So now we have another optimal trade entry here, sells off, fair value gap. This one's better. It's inside of the New York session. Comes back down, spikes up one more time into the fair value gap and optimal trade entry. Sells off, attacks the sell side liquidity here. And then one more pass down lower for offset distribution. Offset distribution. What are you giving me, ICT? When we look for targets, we love to cover shorts or take partials below old swing lows. Okay, just like this low here, you can take a partial here. That would be offset distribution. You're distributing your shorts below old lows to willing sellers. So you're buying back some of the position you're short. So to get out of a short, you have to buy some of it or buy all of it back. Well, here's sellers that want to buy it from you at a low price, and that's what we're doing. So we're taking the ideas of retail traders and we're completely turning it upside down and using it against them. And we're using their liquidity, and very thankful for it too. And the market trades in consolidation into the close at 2 o'clock. Here it is for the 26th, or Tuesday's cable trading. Judas swing again during the London session creates a nice little imbalance here. So there's energy that wants to go higher. So you have an optimal trade entry, buy, fair value gap, bullish order block, rallies up, consolidates, expansion. And then we have another small little optimal trade entry in here with a fair value gap coupled with a bullish order block. So fair value gap, optimal trade entry, and order block. That could be your model. That could be the pattern you're looking for within the context of daily bias. Previous day's high, rallies up, consolidation, rallies up one more time, institutional order flow entry drill. All it needs to do is trade at this candle's price low. And then you can be a buyer there again, and it runs up into the buy side liquidity above the previous day's high into London close, creating the high of the day. Never went any higher than that, consolidating into the close. And then finally today we have previous day's high, the daily breaker. You studied the charts for these, and during the London open kill zone we have a breaker. The market trades lower. 1, 2, 3, 4 times trades into that breaker during really dead time in here. And the market trades aggressively lower, small little imbalance, back to the breaker, high, low, higher high. Last down close candle in that, extend that out in time, breaker, New York session. High, low, pull back up, just fall short of an optimal trade entry, but that's why I don't use just the fib. We're not trading at just 62% retracement levels. We're using discount to premium. So high to low, it goes above 50, and it's at a breaker, and it's at New York session, and it's in a fair value gap, SIBI, sell side and balance spot side inefficiency. All this down movement here gets rebalanced with this move up here. I use the analogy a lot with a paint roller. Okay, if you apply paint going down the wall here, you might have pockets where the paint doesn't get evenly distributed. So what do you got to do? You got to go back up there, right? Well, you can't go back up the same candle once it starts a new candle. So you got to wait until it does it at a later time. And then it does it here. So now it's rebalanced. All of this movement here is rebalanced with buy side delivery. Sell side, it goes down. To be efficiently delivered, it goes up. Once it does that, there's no need for it to go any higher. It can spike a little bit, but not like up here. That's not realistic. It's not expected. I never expect things like that. And over time, you're going to learn that you can sell in here and feel very confident that it's not going to go above this up close candle here, which is a bearish order block. That's your anchor point. Your stop would have to be above that. Entering in here, stop here, and you're reaching for some target on a low end. And again, just like I showed on the Eurodollar, it found the low of the day just ahead of the London close kill zone. Okay, and it's going to happen sometimes. You can't expect perfection on everything. And always, you're going to hear me in this mentorship a lot. My weakness is my exits because I want them to be perfect. And they're not perfect. They're very good, okay, but they're not perfect. And my obsessive compulsive disorder, and I really do suffer from it, it makes me pursue perfection. And I wrestle with it every single day, even on weekends. I want it to be better than it is. And you're going to have a weakness, just like I have a weakness. I have no shame telling you what my weakness is. But my strength is I can go into any market and find an entry pattern and get into it and run it to something. 10 pips, 15 pips, 20 pips, 50 pips, 100 pips, whatever. I can do that part easily. It's not a problem. It's no sweat. I conditioned myself back in the 90s to be fearless going in. But I've always obsessed about finding the best exits. I'm never satisfied with it. And that's why I taught the early lessons on my YouTube channel when I was back on Baby Pips too. You're never going to be right. Okay, you're never, ever, ever going to be right with your exits. There's always a better place you could have got out at. You could have held on to it longer. You could have kept more of your partials on. So you never are right. And I wrestle with that still. In full transparency, I am 100% honest. I'm never satisfied with my exits. I wish they could have been done differently. And I'm talking about winning trades, because obviously if I exit with a loss or a stop loss, or I closed the trade before I should have, that goes without saying. Those obviously can be always improved upon. But even when I'm profiting, I'm never satisfied with my exits. So that, my dear pupils, is going to be the first of all of the new students' exposure to a ICT commentary. I gave you a whole lot in here. And everything in these charts, okay, like the fair value gap in here, it trades back up into it. Mitigation, okay, it's a high, low, high, that's lower. Once it breaks this down close candle here, it trades back up into it here. What's happening here again? Main threshold of the mitigation block. You see a repeating phenomenon and pattern there? It keeps happening, doesn't it? Okay, but you have to know what you're looking for. It's not supply and demand zones. Okay, they're very specific criteria. Like, how do you know which zone to pick? It's just like support and resistance. It's up for interpretation. But when you look at price and you see what it's doing relative to time, are the highs making higher highs or lower highs? Because that's going to differentiate whether it's a breaker or a mitigation block. But what price level do you use for the breaker or the mitigation block? What do you allow for drawdown in your entry? Well, let's just say, for instance, this low here, when it trades up to, that was where you entered. You have to be reasonable and flexible, really, to allow price to move as much as halfway into that mitigation block. That's reasonable. It's not likely to come all the way back up into the top end of it. That's not likely. Usually it's the butt end or the midpoint. But you have to use a bearish order block if you're using a bearish mitigation block to frame your stop. and that's in here. Now, when you have a big bodied candle like that, I'll use the mean threshold of that candle and not the highest high. If this was a small little stumpy candle that was up closed, then I would use the high. But this is a little bit of a range in here, so I would split that mean threshold, and my stop would be just above that by maybe a half a pip or a pip. And I would feel confident that it wouldn't go above the mitigation block and trade into the mean threshold of that candle. So there's some theory there too that I just toss in, no extra charge. But that's going to be it, folks. And I will touch base with you, I'm certain of it, on my YouTube community tab. And obviously this weekend on Sunday, you'll have the next commentary for the ICT mentorship. Again, a warm welcome to everyone that's new here, and to all of you all that's been here. You know the drill. Get back to studying.